All right, we're live. Ladies and gentlemen, welcome. Today, it's Wednesday and it's Thursday and it's Real Talk on Real Estate. So last week and this week, I had to move it because of a real life business that we're facilitating. Last week, I had a zoning meeting over in Phoenix. This week, I had a lot going on down in Tacoma, Washington, and the Seattle area. We're looking for land for a multifamily apartment complex, and we're working on buying land, building houses on our development, our cottage development, Raymond and I. And so, ladies and gentlemen, we'll be back to Wednesday's Real Talk on Real Estate next week. But today, we have an exciting topic, a lot of controversy on this stuff, and we can go a million different directions. So I sat down, I did some research, and we're talking about the mortgage forbearance program and Biden's administration's new measures to prevent foreclosures. And so we're going to go over this stuff in detail and in depth today and bring you guys some real life information and give you guys some reality behind some real life logic. So for those of you guys who want to have a little bit of financial literacy into home ownership and what's going on, I'm going to relate this. All of what we're talking about today, I'm going to relate this to real life. And you guys, because if you're following my channel, it's because you have interest in becoming a savvy investor, or you already are a savvy investor. And so we want to bring you guys information that's relative, not to me, but to you. And it is relative to me and it's relative to all of us. And so it's real important that we understand how this affects us as a nation and those people who can take advantage of the mortgage forbearance program relief, the new measures to prevent foreclosures and all that, more power to them. But how does this relate to what we're doing? Okay, so last year, forbearances, if you guys saw videos that I posted back in probably November, during the whole mass chaos of the pandemic, you guys know that I was talking more so about the masses, the 5 million people at that time that had exercised the forbearance programs. Now, a total of 7.2 million Americans exercised the mortgage forbearance programs. Now, currently, there's 1.75 million homeowners that are still exercising the mortgage forbearance programs. And so for those of you guys that have heard that the mortgage forbearances are expiring and that all these people are going to land up in bankruptcy or they're going to land up in foreclosure, you may want to think again, because ladies and gentlemen, Biden came in and said, hey, I'm going to put together the Biden administration new measures to prevent foreclosures. And he said, here's what we're going to do. And I'm going to quote some stuff here that they've made mention. And I'm going to tell you how this little pivot of information is relative to investors and you guys individually. Okay. Now, what they're talking about is going in. And so all these 1.75 million people, right? Let's say that 50% of those went into foreclosure. Now, some of them will. This measure is not going to prevent 100% of it, right? This is just to take the mass majority of people. And so there's two things that they're doing. And I'm going to go over both those two items that the Biden administration is doing to prevent foreclosures. Now, what we were thinking was before we had all of this mass appreciation of real estate over the course of the last year during the pandemic and all this inventory shortage, we sat back and said, okay, we have an inventory shortage, and all of the housing markets increased between 16 and 20% just in the last 1 year. And so typical markets are between 2 and 3% annual appreciation. So obviously we have superseded that by tenfold in 1 year. Okay, so astronomical growth in real estate prices. Some people sit back and say, we're in a bubble. How is this bubble gonna burst, or what's gonna happen? So we were thinking initially that the forbearances, once they expire, this mass flood of foreclosures is gonna come to the market, and you guys are gonna be able to take advantage of them, including myself. And 2008, all over again, mass hysteria of mass homeownership going south on all of us, right? Well, ladies and gentlemen, there was 5 million people the third and fourth quarter of last year exercising the mortgage forbearances. Now there's 1.75. We need over 2,500 homes to come on the market, even just to have an even market, not a buyer's market, an even market. So for all of you, for information for all of you fix and flippers, now I'm not saying that all fix and flips are bad. We just don't fix and flip because the variables suck compared to buying land and building houses and generating larger profits. Now, does that mean that we won't fix and flip if we find a rare opportunity or a viable opportunity to do so? Absolutely not. So if we happen to stumble across one of these foreclosures and it comes to our table, we'll go ahead and exercise a purchase on it to take advantage of exactly what we would encourage all of you guys to take advantage of. The problem is we're not going to see the type of gross numbers we were looking at for people to take advantage of those. So we're still going to remain in a very tight market in regards to inventory. And so here's what's happening. So Biden came in, he said, look, I'm going to offer housing assistance measures to prevent foreclosures on government-backed loans. That's FHA loans through the USDA, the HUD loans through urban development of housing and veteran affairs, right? So the VA loans. And they wanted to go in and say, okay, we need to get in line with Fannie Mae and Freddie Mac. And so now, because of this measures, they believe that they have something that the HUD, USDA, the VA are now in alignment with Fannie Mae and Freddie Mac. And so what they're doing is they're saying, okay, Americans, you're no longer going to face financial hardship due to the pandemic. Okay, and here's how. First thing is they're going to move missing payments to the end of the mortgage, of your mortgage, if you guys are exercising it, at no cost. So anybody that is on the mortgage forbearance program, we're going to go ahead and push all of your missed payments to the tail end of your mortgage. Okay, you don't have to pay any of it at no additional cost. And so that way, those people who can now afford their mortgage, where during the pandemic they couldn't, they're going to push all of those mortgage payments at no additional cost to the back end of their mortgage. Okay, so that's the COVID-19 recovery modification. Okay, so what that does is it extends your mortgage terms 360 months at the current interest rate. Okay, so if you had an interest rate of 6%, and now you can get a 3.1% interest rate or 3.4% interest rate. It's at the current interest rate, and the whole goal behind this is to reduce the payment and interest, the P&I, on that on your existing mortgage by 20 to 25%. Now that gives you they back up your mortgage. So for sake of example, if you've been paying your mortgage for 15 years, they're going to come in and say, look, we know you only have 15 more years to pay off your mortgage, but we're going to kindly give you guys an additional 360 months, 30 years on your mortgage. So you go all the way back to zero again, all the way back to the first day you bought that house, 30 more years. We're going to give you a lower payment of about 25%, give or take. And congratulations, it's our way of saying we're helping you. Okay, that's what the federal government's going to say. Now, look, ladies and gentlemen, I'm going to sit back, and I got some controversy with this because I think that home ownership is great, right? I'm a homeowner. I exercise my home ownership slightly different than most people. And the reason is because I know that any purchase in the real estate sector that isn't cash producing is not an asset. It's a liability. So the way I look at home ownership is you own a liability, because if that house is not producing income for you, it's a liability. So the way home ownership is I don't look at home ownership as an asset. I look at it as a liability. Here's why. Look, ladies and gentlemen, I owned my first home for 18 years. When I built that home, I paid $225,000 to build it. And then I put about another $50,000 in landscaping and improvements, fences and all this other stuff. So $275,000. Now, over the course of 18 years, I landed up putting in a new kitchen, new countertops, new doors, new flooring one time, and all this other stuff with landscaping modifications. And so I landed up probably dumping into the house another $100,000 into it over the course of time. So plus the interest I paid over 18 years and everything else, I probably $500,000 into this house. Well, when I sold the house 18 years later, I sold it for $475,000. And ladies and gentlemen, I have that much, if not more, into it than when I bought it. And so, yes, I landed up getting a little bit of my money back out of it at the sale because I didn't owe that on it. I owed substantially less, but I landed up mortgaging that house a second time to pull capital out, to go out and buy land and build houses cash. And it was the best way. So my house wasn't a liability now. My house became an asset because I took the cash out of that house that I had in equity and I put that money to work. And that money at work landed up making me a millionaire because I landed up revolving that capital over the course of multiple years and duplicating it through investments in real estate by buying land and building houses. And I built one, then the proceeds from that, plus what I had already in equity, plus what I had made in my business, I built two. Then I went two, I built three. Then I built five. Then I went up to 12 a year, and we were able to generate a lot of capital. Ladies and gentlemen, that is home ownership at its finest. And that's how you utilize your house to become an asset as opposed to a liability. But for all these people that are exercising the mortgage forbearances, they're going back in, the federal government. They're saying, look, we're going to save you. I know you only owe 10 years, 15 years, 20 years in your mortgage, but we're going to stick you back into a 30-year mortgage at the current interest rates so that we can continue to take money from the American people in their mortgages so that they can go out and we can ensure that you can afford to build equity long-term. That's quote unquote. We want to ensure that you can afford to build equity long-term. That's what they're telling the American people. Not only that, second quote, they say, we want to help decrease the lower income and the underserved borrowers. And we want to help them build wealth through home ownership. So ladies and gentlemen, there are people who build wealth through home ownerships if they just happen to hit the right market and they sell at the right time. For sake of example, we're buying homes in the Seattle area. Google and Microsoft extraordinarily go in here and create an influx of mass mass appreciation of real estate due to the high income level of people moving into that area over the last decade or decade plus. Okay. And so here's what happens. So companies like this go in. Now the average income is over $140,000 a year to the average household. So the average home out there is over $700 and some odd $1,000. We build these little 1,500 square foot houses and sell them for $1.1 million. And they're the affordable housing in the market. Now, ladies and gentlemen, we're going out and we're purchasing lots that have pre-existing homes that were built in the 70s and 80s. People paid $150,000, $180,000, under $200,000 to purchase these houses. And now we're purchasing these houses for $900,000. We're leveling them and we're building 4 to 6 houses on every single lot. Ladies and gentlemen, that's wealth creation. If you become a millionaire selling your house that you purchased in the 80s or 90s for a very low price, and then you sell it for that. But how many people across America purchased a $200,000 house that is now worth $1 million or just shy of? Very, very few. And so, ladies and gentlemen, when I read this, I sit back and I scratch my head and I say, goodness gracious, our federal government is selling people on the fact that they're going to provide people with the ability to afford to build long-term equity and build long-term wealth and equity in their homes through the means of home ownership. Ladies and gentlemen, home ownership is one of the biggest scams in regards to mortgages. You can go in, you can buy a home, you can exercise the interest write-off, and that way you can go out and offset it if you need that as a business owner or even as an individual. But ladies and gentlemen, home ownership, when you purchase a home, you end up paying almost 3 times the purchase value of that home if you have a regular mortgage. And so if you go in and you obtain a mortgage, it's all interest weight heavy on the front end of that mortgage, which means that the mass majority of everything that you pay is not going to principal. It's going towards interest payments for the first 10 years of you having that loan. So if you were now currently at a point where you're past that 10-year mark and you're going to go refinance your home into another 30-year mortgage, ladies and gentlemen, you're doing yourself a disservice because now you're going to pay for that home probably 4 times over the original purchase price that you originally purchased it if you do assume another 30-year mortgage and if it takes you 30 years to pay that mortgage off. So ladies and gentlemen, if you purchased a house for $200,000 and if you refinance it because you've been into that home for 10, 15 years and you pay 4 times that, that's over $800,000. Now, ladies and gentlemen, if your home does not appraise for $800,000 and you're not even going to break even, guess who all that money goes to? Your mortgage lenders. And so if you guys believe that you guys are getting a favor done to you by exercising the COVID-19 Recovery Modification Extension program, I would reevaluate it if you're not in a position where you absolutely have to refinance that mortgage and refinance that house. Be cautious if you're one of the few that have the ability to stay in there and take advantage of just repositioning and catching up with your mortgage payments or putting it to the back end instead of refinancing that house. Now, second thing is you're able to go in and provide 25% reduction in borrower's monthly P&I, which is payment and interest. And that's through the COVID-19 Recovery Standalone Partial Claim. When you refinance or sell the home, that actually falls in the COVID-19 recovery modification on your extension mortgage is when you exercise the 25%, or you can exercise the COVID-19 recovery standalone partial claim, which is when you go in and you refinance your home, or you go in and sell your home, you're able to pay back the missed payments. And because of the mass appreciation, ladies and gentlemen, people got lucky with this. And so because of everything that was happening with the inventory crisis, what landed up happening was people landed up being able to go in and refinance their home and they were able to assume new mortgages because the appreciation of real estate was obviously large, and the value of their home went up by 16 to 20% this past year. So for those of you guys who were able to do that, more power to you, especially for those of you who sold your home. Less so than the ones who refinanced it. Now, if you refinanced at a lower interest rate and you've got a 20-year note as opposed to a 30-year note or a 10-year note or a home equity line of credit, and you paid off your mortgage through what's called a HELOC, a home equity line of credit, then you, ladies and gentlemen, are the smart ones, because you, ladies and gentlemen, just received a home equity line of credit, which is weight heavy on the back end of that loan instead of the front end. And even though your payments today are more expensive, you're going to pay your house off in a substantially quicker time period and save yourself hundreds of thousands of dollars, if not millions, depending on the price of your home. And so, ladies and gentlemen, I wanted to bring to you guys today the Biden administration's new measures to prevent foreclosures. So for those of you guys who thought you were going to pull out your dustpans and brooms and sweep up all the foreclosures and go in mass hysteria and purchase all these up like we did in 2008, you might want to think again. Because, ladies and gentlemen, the Federal Reserve and our federal government is back at their best, putting people back into 30-year mortgages and collecting interest from them. And let me explain this to you guys. For those of you guys who are questioning and doubting anything that I'm saying, understand that the Federal Reserve in 1912 was created and formed, okay? And so in 1912, when the Federal Reserve was created and formed, it's a non-governmental agency. And so what happened in 1912 is the central banking system created the Federal Reserve. And they said, we're going to print money and we're going to lend it to our federal government, which is non-constitutional, but it happened. And so in alignment with our federal government, the Federal Reserve was created by the central banking system. And they said, we're going to go ahead and lend you guys money that we print, and the federal government's going to pay us back at a rate of approximately 2%. Now, where's the federal government going to get the 2% to pay us back? They're going to implement what's called income taxes. So in 1913, 1 year later, our federal government said, U.S. Americans, we are going to implement what's called income taxes. And we're going to charge you guys a percentage of your income so that we can pay back the Federal Reserve for all this money that we're borrowing from the Federal Reserve. And so in 1913, you guys can go back in and do this research. You guys can Google this stuff. Now, when you do this, it's a little bit tougher to find because a lot of governmental agency stuff that comes in about taxes and stuff pops up below it. But if you scroll down a little ways, you'll find all the real information about the Federal Reserve, the central banking system, and how it actually works. And if you guys do a little research, you guys will understand that what I'm telling you guys is point on. And so this is stuff, ladies and gentlemen, that our federal government doesn't want you guys to know about. And also it's not taught in schools. And so one of the big things that was very controversial is the fact, like when JFK was assassinated, one of the big things that he was plotting that year was to dismantle the Federal Reserve. And then, ironically enough, he landed up assassinated. So I'm not saying that that was the reason. I'm just saying that it's pretty coincidental. And so as we sit today, we still have the Federal Reserve, and our federal government is still implementing income taxes more so now than ever before. And they're even trying to get rid of capital gains taxes. So for those of you guys who think that our federal government is helping you in these government assisted loans and mortgages, you might want to think again, because what's happening is it is the number one most affluent way that the Federal Reserve and our federal government makes money is through home ownership, selling you guys into mortgages and having you guys become homeowners in owning what I call a liability, not an asset. An asset, ladies and gentlemen, in real estate, for those of you guys who want to get affluent in financial literacy, is an asset. An asset is something that produces income for you in spite of your own efforts. And so, ladies and gentlemen, that's not a single family home. Now, am I telling you guys, don't go out, don't buy a single family home because it's bad? No, ladies and gentlemen, I got a wife, I got children. Having stability in your life and having a place that they call home is great. But just understand that what I teach is I teach financial literacy. What I teach is how to go out and become an investor in real estate and how to create wealth in real estate. And so for those of you guys who are sitting back going, oh my God, our federal government did it again. They're going to save the world. And Biden, I love so much. And ladies and gentlemen, it's just our government. So whether you love Biden, hate Biden, doesn't matter. All that matters is you guys understand the difference between a liability and an asset. And what I'm telling you guys is it's not a bad thing to own a single family home. Just know the difference so that you know how to position yourself on the wealth creation side of it so that you can really create wealth. And wealth is created over the course of time by creating passive income through your investments so that your assets work on your behalf instead of you going out and single-handedly working to create wealth on your own. So when you have real wealth in real estate, understand, ladies and gentlemen, that real wealth in real estate is created through cash producing assets, multi-unit real estate that has rental income that comes in spite of your efforts, passive income that appreciates over the course of time. So as rents appreciate, the value of that property appreciates, you're able to depreciate it on your taxes, saving the tax money, and your assets still going up. And so you're saving money through the means of tax depreciation or expenses in your assets, and your appreciation and your rents continue to go up. So when you buy whole and have cash producing assets, ladies and gentlemen, those are assets. But a home, ladies and gentlemen, is truly a liability if that's all you have it for is a single family home over the course of time. And so the goal, if you guys are watching this, is for you guys to become financially affluent and become savvy investors. See, we have a question. Doug, the vampires sacrifice lives and freedom of the young to keep the frail undead. Sorry, this thing is small. Marginally longer. They change the narrative and move the goalpost. What will they demand of the children of tomorrow? Yeah, what will they demand of the children of tomorrow? What else are they going to sell your children in tomorrow that they're not already selling them in today? So ladies and gentlemen, I wanted to bring you guys this information, and you guys might be sitting back saying, this guy's full of shit. Do your research. Ladies and gentlemen, I've been living this for over 26 years. I've been in real estate development. And ladies and gentlemen, understand that you can go in and research everything that I'm telling you guys here, and you're going to sit back and say, you're going to sit back floored and go, oh my goodness, that Jerome Maldonado is 100% right in everything that he's saying, whether it creates controversy or whether you want to believe it or not. Ladies and gentlemen, your single family home is a great place to house your family and your children, but it's a liability. It's not an asset. Unless you bought your single family home like we did. Ladies and gentlemen, that's for a whole different topic, a whole different story. But ladies and gentlemen, because we are in the business of real estate investing, multi-unit real estate, buying land, building houses, we have positioned ourselves to make our home an asset, not a liability. And you should too. Let's see, Benny here. What do I think about the probate houses? So probate houses are houses that are caught up in probate. Benny, is what I think you're talking about. So like if someone dies and it gets caught up in probate, or someone goes through a divorce and it's caught up in probate, Purchasing probate houses are great if you're patient. And so if you're exercising the purchase of real estate as a business all the time, buying foreclosures and probate houses are great, because if you go in and put your offers in, it's not emotional. You're not sitting there based on a time frame saying, I need to get into a house and I need to move into it next month. You could sit back and put in an offer and exercise the probate requirements to be able to put and facilitate an offer on that property, or on a foreclosed property, an REO property, a short sale property. All of those purchases take time. So over the course of time, it might land up taking you 60 days, 90 days, 120 days to get an answer of approval on the purchase of that property, because the banks move slow depending on what's on their plate. And most banks have a foreclosure department in themselves, separated from the lending department, that only deal with REOs, bank-owned real estate, and foreclosures or short sales. And so if you're patient and you have the ability to wait over the course of time to be able to put an offer in on a probate property or foreclosed property, then it's absolutely incredible. But ladies and gentlemen, that stuff takes a little bit of time. But yes, that's the way to purchase real estate. And so like I've been telling you guys, we have an inventory crisis right now. There is not enough inventory in the market. So that's what's creating this mass hysteria of inflated prices of housing. And so what's happening is fix and flippers are going out there overpaying for houses that they have to put more money into, and then they're selling it for a more appreciated price. When all of this comes stable, which it will over the course of time, what's going to land up happening is it's going to halt. And it won't halt overnight. The warning signs will be on the wall. But what happens is people continue to press and press and press, and then they get caught in it, trying to get as many of these pushed out as humanly possible before the market hits its stopping point. And so I tell people, why put yourself in that position? So instead of going out and trying to buy inventory that doesn't exist, why not create inventory where you go out and buy land and build houses where your variables are substantially lower, your variables are substantially less, your liability is substantially decreased. The hardest one is your first. And once you figure out how to do the first one and you're coached through it by someone like myself and you have success, the rest of them are just another day in the office, ladies and gentlemen. So instead of going out and trying to fix and flip, go out and create inventory by buying land and building houses. Then we'll teach you guys how to deploy that into long-term cash-producing assets that have passive income in spite of your own efforts. And so, ladies and gentlemen, that's how you create wealth in your life. For those of you guys who are lower income or underserved borrowers, you're the ones that need to be exercising this type of stuff. Now, if you're at an age of retirement and you're at a point where you need to take advantages because you're on a fixed income, there is a need for this someplace for somebody, but not for the masses, ladies and gentlemen. There might be someplace in the neighborhood of about 25% of these people, maybe 50% of them, that can benefit from this, but the other 50% or better aren't going to benefit from it. It's a hindrance. And so I just want to educate you guys to understand what they're getting into, what you're getting into, and so you have the abilities to make a logical decision as investors if you're put in this position yourself, and to understand how to take advantage of this if these foreclosures come to the market, which will be in a more minute quantity at this point in time. Sam is asking, what would a good warning sign be that the cliff is near? So interest rates rising is one warning sign for sure. The inventory starting to stabilize is a second, where you start hearing, staying up to date with the National Association of Realtors, watching the numbers each month, subscribing to those type of newsletters and information is where you find that information. So Sam, it's by being proactive, because by the time it hits the news media, it's too late. Once CNBC, KOB, and CNN and all these other mass networks already have the information, so does the rest of the world, and it's too late. So don't wait for the warning signs to be written on the wall. Be proactive. Go to the areas that have the real data and the real information. Look at the real numbers. Go and look at what's happening at the National Association of Realtors. Go see what's happening at the National Association of Home Builders, and go and read their monthly newsletters and see what they're posting regularly and see what the numbers are. Go back and look at what they were writing in 2020. Go back and see what they were writing in January, February, March, April, May of 2021, and continue looking at it every single month and see what's happening as we move forward in the future. Because ladies and gentlemen, that's what I do. And the information I get from you guys, it isn't like this aha moment that gold comes down and is presented upon me. It's information that's public information that's at our fingertips that most people never Google or look into. They just wait for the media to be able to go out and deliver it to them. And then it's too late. The information's everywhere. It's too late. The information is already available months in advance. All you have to be is smart enough to go out and find and leverage that information and apply it before those warning signs are right in front of your face. So in other words, don't wait for the car in front of you to stop completely before you hit your brakes. If you see the brake lights from up ahead on multiple cars, start easing up on your brakes so you don't get in a you don't get into a rear end collision, right? And that's what people wait. It happens to so many people is they don't look at the brake lights, which are warning signs in advance. They land up getting right up on somebody, slam on their brakes, hoping they can stop, and it's too late, and they get in a rear end collision. Ladies and gentlemen, look for the lights in front of you, slow down and ease into that stop so that you can go in, pivot, and move around it and continue moving forward. And that's how you go out and you compound your success as a real estate investor. Ladies and gentlemen, thank you guys. If you like what's the information that I'm delivering to you guys, give us a thumbs up, ladies and gentlemen, and click and subscribe if you haven't already. And ladies and gentlemen, thank you guys for joining us. Thank you, Antonio. Love you guys. God bless you. You guys go out and make it a great day.